All right, so the 10-year Treasury is at 392. The 5-year Treasury is at 393. Treasuries have officially dropped a full 100 basis points since the end of October. But while interest rates have come down, they haven't come down a full 100 basis points. And I'm talking about interest rates like if you're going to go get a loan, if you're going to buy an apartment building, pretty much. Those rates have not come down the full 100 basis points that Treasuries have actually dropped. Now, part of that is that most of our banks have pretty much thrown in the towel in 2023 and taken a wait and see approach. So I anticipate we're going to see more rate improvement in January when everyone's back from their holiday vacation. But in exciting news, the Fed actually pivoted last week. Now, I don't know if you guys heard this, but not only did he confirm that he's done hiking, but he actually said he expects to cut 3 times next year. Now, we all know the Fed's famous for going farther than he says he will. After all, he started hiking in 2022. He said they were only going to raise rates 0.75% or 75 basis points. Then he proceeded to raise 5.5% over 16 months. And there's a long history of this over multiple downturns. He always goes too far. Now, what am I seeing for 2024? I know I've talked about some predictions over the last several months, and quite frankly, a lot of it is pretty much the same. I mean, it's in line with pretty much everything I've been saying over this year. But I was talking with one of my bankers last week, and they are forecasting multifamily financing is going to pick up significantly in Q2 or Q3 of 2024. So that's good news for all of us. As I've said before, we've hit the peak of interest rates. Treasuries were close to the 5-year and the 10-year were darn close and even kissed 5% there for a second. And now it's dropped more than 100 basis points since that time. So that is the peak of what we've seen. Now, multiple sectors of real estate have been in a literal depression because of rising interest rates. And there have been far less transactions for real estate agents, investors, and lenders alike. Lenders especially though, right? Because investors have been buying with maybe private money or seller financing, or they've been assuming existing financing. So there have been some additional transactions. I really see that lenders have been the most hurt out of this whole thing, but really transaction volume is down significantly for everyone across the board. So now it's our time to slowly start improving while the rest of the economy is going slowly into a recession. Yes, I am betting on a recession in 2024, not a soft landing. Why? Because there have been 4 soft landings since 1965 and 8 hard landings. So that means 33% of the time the Fed has managed a soft landing. Now, that's not so bad, but when you take a look at what constituted a soft landing, the Fed hiked rates by a maximum of 3%, and we've already hiked 5.5%, and the longest period was 18 months. So this time around, like I said, the Fed's hiked rates 5.5%, and so far it's been 21 months since he started. So if we had a soft landing, this would be the first time in history it's happened when they've hiked rates so quickly over this period of time, meaning that we haven't gotten out of this in less than 18 months. So I don't foresee a soft landing happening. If so, it would be like making history. So I'm not placing my bets on that right now. It's very low probability. So that said, I'm not saying that we're going to have a really bad recession. It's not going to be like the Great Depression. I don't think so anyways. I honestly don't believe that it's going to be really that bad, but I'm almost positive that we're going to have a recession. So that I can say. How bad and how deep and how long it is, of course, that remains to be seen, but I do anticipate us seeing a recession. So for most of us in real estate, that means things are actually looking up, and we've gotten through the worst of it in our industry anyway. So what does a recession look like? Well, it definitely means that we're going to see higher unemployment. Now, right now, we're at 3.7% unemployment. And if we're using history as an indicator, we should plan to see unemployment somewhere in the 5 to 5.7% range by late 2024 to mid 2025. And we can expect to see it rise at a faster pace than it has in 2023, because historically, once the yield curve uninverts, which will happen once they start dropping rates, we usually see about a 2% increase in unemployment over the next 18 months. So that's what we're looking for, is for that yield curve to uninvert. And once it does, we're looking at seeing probably a 2% increase in unemployment, which puts us around 5.7%. Of course, I always give a range because it's not always like perfect. So I'm saying 5 to 5.7% in my prediction. And now that we all know the Fed's going to cut rates, he said 3 times and 0.75%, but we also know that secret code for he'll be cutting more than that, probably more like double that. The market is actually betting that we're going to see the Fed funds rate below 4% at year end. So that means the market is betting that the Fed's going to cut rates at least 150 basis points. Because if we're at 5.5 right now and they're planning on us being below 4, that means that we're going to drop at least a minimum of 150 basis points, aka double by year end. Now, to my last prediction, interest rates. The historical spread between the 10-year Treasury and the Fed funds rate is 1.4%. Now, I think that we've seen the bulk of the move already. So I think we're going to see the 10-year somewhere between 3.25% and 3.5% by the end of next year, unless the economy actually does have a hard landing. I think we're going to see Treasuries move down more, but at a much slower pace than we've seen over the last 6 weeks. But I keep saying this because it's true. Banks are keeping a super thick margin right now. Remember, banks hate uncertainty. So earlier this year, I predicted interest rates would be 5.5% to 6% by summer. And I still stand by that. But at this point, I think we're going to be closer to 5.5%, maybe even a tad lower by year end. So I'm still recommending getting a loan with little to no prepay if you're buying or need to refinance in the near future so you can take advantage of low rates and refinance when they come down. That is it, everyone. I hope that you have a wonderful Christmas and Happy New Year. And I'm looking forward, I'm sure you all are too, to a more fun market next year. So Merry Christmas, Happy New Year. I am around for the holidays. If you have any questions, you're running numbers on deals, you want to talk more about the market, I'm around. Give me a call, send me an email, reach out.